and you can watch everything that goes on and you still can carry on that conversation. For me, baseball is a social sport. That's why I like it, besides the math of it. Anyway, I think that we've finished. It's time to get started.
Mike, we have hit the top of the hour. Welcome everybody to this week's episode. Mike has got a great one lined up for us today, where he's going to be giving us some insight into what happens if oil hits 150 or more, and what that does to your financial plan. Mike, I am looking forward to this because I love how you take 40 years of experience and bring it all together in a way that we can all understand. My name is Chris Prouty. I'm going to be here monitoring the chat and the Q&A. I'm going to vanish while Mike is presenting, and then I'll come back a little bit later on to moderate and send questions over to Mike. So Mike, with that, have a great presentation. I'll see you at the end.
Well, thanks for being here. 1 in 4 investors with a financial plan is unhappy with their advisor. And that's right now. 1 in 4. And if you're listening to this, there's a decent chance that you're one of them. And here's what's interesting. Most people in that group can't quite put their finger on why they're unhappy. The returns feel off. The conversation feels thin. Something just doesn't add up. So today, I'm going to tell you exactly what that something is. But first, I need to ask you a question that most financial advisors would rather you didn't think about or didn't think very hard about. If oil hits $150 a barrel, does your financial plan still work? I'm not being dramatic. The Strait of Hormuz, the narrow waterway through which roughly 1/5 of the world's oil supply travels, it's currently under severe disruption. Energy markets are repricing. Financial plans sitting in your advisor's drawer right now, it was almost certainly never built for what may be coming. And most people know that. Stick with me for the next 20 minutes and I'm going to show you exactly what your plan is built from, why it's vulnerable, what history tells us about what happens next, and what a genuinely different approach actually looks at. Just give me 20 minutes. And at the end, I'm going to make you an offer. Not the typical free consultation every advisor dangles. Something more specific, something more valuable, something you can actually use, whether you ever choose to do business with me or not. So let's get to it. Before we talk about oil and what's happening in the Persian Gulf, I want to start with something that might surprise you. I want to start with what's inside your financial plan. Because most investors, when you actually ask them, have only a foggy idea at best. They know there are stocks, bonds maybe, something called alternatives. Their advisor put it together. It looked professional. They signed off on it. ETFs, mutual funds. Here's what the industry data actually show. Investors approaching or already in retirement are typically allocating between 35 and 60% in fixed income. That means bonds or bond funds, bond ETFs, annuities, CDs. The other position sits in equities, domestic stocks, or index funds, ETFs. Modest slice of what investors and advisors call alternatives. Now, is that a bad plan? Not necessarily. For the right environment, it's actually quite sensible. Fixed income provides stability, annuities deliver guaranteed income, equities grow over time, alternatives add a little diversification on the edges. The question isn't whether it's a reasonable plan. The question is, reasonable for what environment? Because that architecture, that heavy fixed income base, that equity layer, those alternatives, they were designed for a very specific kind of world. A world of moderate and stable inflation, predictable interest rates, and a Federal Reserve with room to maneuver. That world prevailed for 40 years, from 1982 to about 2022. And that's exactly the period most financial advisors draw their performance from. I'll come back to that date, 1982, and why it matters so much. And when I do, I think a few things are going to click for you. But right now, I want to ask you 3 questions, not to make you feel bad, but to give you something to really sit on. Question number 1, how much of your current portfolio sits in fixed income, bonds, bond funds, annuities, CDs? Do you know the exact percentage? If your advisor walked in right now and you ask him, could he tell you in 30 seconds? Could you? Question 2, your annuities and your bonds, they offer a guaranteed nominal return. But who guaranteed that nominal dollars? Would they still buy what they buy today? Your annuity promises you a check for a certain dollar amount. It doesn't promise you what that dollar amount will purchase at the grocery store 5 years from now. Who's on the hook for that gap? Question 3, the alternative investments in your plan. Have you ever been stress tested through a genuine, prolonged inflationary cycle? Or were they put together during the 40 years of relative price stability that ran from 1982 forward? Sit with those. We're going to come back to them. But first, let's talk about what's happening right now and why it changes the math of everything I just described. Let's say let's say we have 2 scenarios. There's the Strait of Narrow choke point. In some places, about 21 miles. You've been reading about it. You've been seeing it on TV. The Strait of Hormuz. It's connecting the Persian Gulf to the open water. 1/5 of the oil moves through it. You know that. Saudi Arabia, UAE, Kuwait, Iran, Iraq, all the crude funnels through this one passage. Its disruption is not hypothetical. It's a current reality. The only question is, how long does it last? And there's 2 scenarios, and neither one is comfortable. Let's look at scenario number 1. Let's say diplomatic or military action restores the passage within a couple months, within 1 or 2 months. Oil prices slowly recede from their highs because prices tend to go up like a rocket and come down like a feather. But here's what doesn't disappear. When the headlines move on, a spike to $150, even a brief one, floods through the entire economy. Transportation costs surge. Food prices follow. Manufacturing inputs go up. Utilities spike. The Federal Reserve, which already is managing existing inflation pressures, faces a new shock wave on top of everything else. And here's the critical thing most people miss. The Fed's tools don't cure supply shock inflation. They can't reopen the Strait of Hormuz. What they can do is slow demand, reduce demand, cool hiring, tighten credit, and the aftershocks of a 60-day energy spike can take 12 to 18 to 24 months or longer to work. Prices go up like a rocket, they come down like a feather. So ask yourself this. If inflation runs 2 or 3 points above your plan projected, even just for 1 year, how does that affect the purchasing power of your income over a 20-year retirement? The math compounds. A small miss early on creates a huge shortfall later on. And if the Fed is forced to contain the aftershock, what does that do to the market value of the bonds and bond funds already in your portfolio? Bond prices move inversely to interest rates. If rates stay high, your bonds are worth less. That's scenario 1. That's actually the good outcome. But if the strait remains restricted for 6 months, or 12 months, or 24 months, elevated energy costs stop becoming an event. They become a structural condition. Because businesses can't afford They can't absorb the margin compression, and they'll start cutting headcount. Consumers stretched at the pump in the grocery store start buying less. Growth slows, unemployment drifts higher, and yet prices don't fall because the supply problem is still there. That's the environment that produces a word most financial planners haven't used seriously with their clients in 40 years. Word is stagflation. And I'm going to spend a moment on this word because it's important and because the way most people imagine it is wrong. Stagflation is not a market crash. It doesn't announce itself with a dramatic drop. It's quieter than that. It's a long, grinding erosion, rising prices, month after month, year after year, alongside stagnant growth, slowly declining, slowly. Unemployment slowly climbing. It's not like the Great Recession of 2008 where unemployment shot to 10%. It's slow and grinding. And the portfolio statement might show nominal gains, but they're being eaten alive by the real cost of living. And here's what makes it especially dangerous. The official consumer price index, the CPI, tends to understate what people actually experience. It doesn't capture what you pay at the grocery store. It doesn't capture healthcare. It doesn't capture what the goods most people buy. The real purchasing power structure is worse than the headline numbers suggest. And it seems increasingly likely that the United States is moving towards stagflation, whether the strait reopens or not. The short disruption leaves an inflationary residue. The long one makes it structural. Either way, the direction of travel is toward raising prices and pressuring your purchasing power. And most financial plans weren't built for that direction. Coming up, I'm going to show you exactly what history looked like the last time this happened. And the numbers are going to surprise you. Because I can promise you, your advisors, I knew I should have. Forgot to put it back on airplane mode. Sorry about that. So let me come back to this. Because I believe the last time this happened, the numbers will surprise you. And your advisor's performance chart is not going to show you what happens. So what did happen? Here's the question that's worth asking your advisor. When you look at the performance data in your financial plan, the backtesting, the historical projections, what year does it start? I'll tell you what most of them start with 1982 or 1983, sometimes 85, sometimes 1990. And there's a reason, because the time before that is not a story of the traditional allocation model. It doesn't tell it well. Let me walk you through what actually happened starting in 1966, because this history is directly relevant to what may be unfolding right now. 1966, the Dow hit 1,000 for the first time. Generational milestone. Investors who were there remember it as a time of optimism. What followed wasn't a crash. There was no single dramatic event that wiped people out. What happened was something quieter, in some ways harder. The Dow began to decline, and it slowly declined from 20% from that peak, and then it recovered to 1,000, and investors felt okay. Then it declined 30%, slowly, month after month, came back 30%. Then it came back again, and people felt good again. Then it dropped to 40%, the deepest of the cycle, compounded by the oil shock of 1973 and 1974, 7 and 8 years after it first hit 1,000. Then it recovered again. Then it fell 20% as inflation peaked above 13%. By 1979, 13 after the Dow first touched 1,000, the index touched a bottom. And Business Week came out with their article saying the death of equities. It took until 1982, August of 1982, before the Dow hit 1,000 and began to continue to climb. Those are the nominal numbers. And over that same period, the consumer price index, from that time until 1992, the consumer price index increased sixfold. A lot of other prices increased even higher than 6 times. But you know what? The Standard & Poor's with dividends reinvested didn't increase sixfold until 1992. 26 years later took to catch up with the consumer price index. And the consumer price index understates what most people paid. I want to ask you a question. I've been building around. Your advisor's performance projection, do they draw on data from the early 1980s after stagflation ended? Or do they account for that with the same strategies returned during the previous 16 years? The alternatives, when were they developed? Were they stress tested in an environment where declining inflation, falling interest rates weren't the tailwind? And here's the hardest one. If the S&P 500 with dividends reinvested took until 1992 to match inflation from 1966, and a similar situation begins right now, do you have 26 years to wait? Do you have 26? Now, history never repeats, but it rhymes. So we can draw from that example, from that period of time. And a lot of investors that I talk to don't. They're near retirement. Time is the thing that they can't replace. They can't wait that 26 years. And I want to pause for a moment because I know it's a lot to take in. And I know it might be prompting some uncomfortable questions in your own situation. And that's actually good, because the investors who come out of cycles like this are in the best shape are the ones who ask the uncomfortable questions before it begins, not afterwards. So stay with me, because in the next few minutes, I want to talk about what a genuinely different approach actually looks like. Not more diversification, not a slightly adjusted allocation, but something fundamentally different. Let's be fair for a moment. The conventional model, significant fixed income, a layer of equities, a cap of alternatives, not a bad plan. And I want to be clear about it. It's a sensible plan for the environment it was designed for. The environment was moderate growth, moderate inflation, and a Federal Reserve with plenty of room to maneuver. And that environment prevailed for 40 years. If you're an investor from 1982 to 1982 to 2022, that framework largely worked for you. The problem is that framework is not resilient for this environment. And yes, I used the number 2022 because we know what happened in 2022 with inflation soaring up to 90%. It's come down, but will it? In a stagflationary world, this is what happens in a traditional pyramid. Bonds lose real value. Inflation is rising, which means the purchasing power of the fixed coupon payments is declining. And if the Fed keeps rates elevated to fight it, the market value of your bonds goes down too. You're losing on both ends. Annuities, that guaranteed income most advisors point to as security, they deliver a guaranteed nominal payment normally. And if inflation runs at 6 or 7 or 8% for several years, or even as high as 13% as it did in the 70s, A payment that seems generous becomes inadequate. When the check arrives, what it buys is the problem. In equities, they struggle when growth is simultaneously stagnant. Companies can't grow earnings fast enough to justify their prices. Investors who stay the course will watch nominal values gyrate while real purchasing power steadily erodes. And alternatives, in most plans, they're added to smooth volatility during recessions. They weren't stress tested for inflation. They were assembled during the first 40-year tailwind, the last 40-year tailwind. The diversification that was meant to protect you doesn't actually protect against the slow grind of purchasing power destruction, when every asset class is eroding together in real terms. So now, let me ask you 4 questions. 1, when was the last time your advisor reviewed your holdings specifically through the lens of sustained inflationary environment? Not just a recessionary one, but a sustained inflationary environment. 2, when was the last time your advisor reviewed your holdings specifically in today's dollars? What do those dollars have, and what will they purchase if they're 30 to 40% reduced purchasing power? Didn't state that question very well, but you can understand what happens if your dollars will only buy 30 or 40% less today, or less in the future than they will today. 3, does your plan have any provisions, any positions specifically designed to hold or gain real value, not just nominal value, during a prolonged period of rising prices and stagnant growth? And 4, has your advisor walked you through 1966 to 1982 and shown you what your current strategy would have returned in real purchasing power and growth? If the answer to most of those is no, that's not an accusation. Most advisors weren't trained for that environment. Their whole career has been built in this 40-year tailwind. They learned to optimize for the world that exists and has existed from 1982 forward. But that may be ending, and a different approach is required. So let me tell you what it looks like. And I'll tell you. The Adams Financial Concepts approach starts with the premise that the traditional model quietly abandons. The goal of investing is not to match an index. It's not simply to smooth volatility on paper. It's to maintain and grow real purchasing power over time. Sounds obvious, but almost everything about the conventional approach, the broad diversification, the benchmark hugging, the set and rebalance discipline, is optimized for nominal returns, not real returns. In a moderate inflation environment, that distinction doesn't really matter. But in a stagflationary environment, it becomes everything. Here's the core of our approach. Rather than spreading capital across hundreds of positions in a broad allocation model, we concentrate on a carefully identified of what we call focus stocks, companies with specific business characteristics, earning power, pricing power, competitive position that gives them the potential to grow faster than the cost of living, even when the cost of living is rising fast. Think about what that means in practice. A company that can raise its price when inflation rises and maintain its customer base while that happens. It's not just surviving inflation, it's participating in it. The inflation isn't eroding your purchasing power through bonds. It's actually flowing into the company's revenue lines. That's the kind of businesses we look for. Now, I want to be direct. It's not a strategy for everyone. It requires a different kind of discipline than the set and rebalance approach of traditional pyramid. Concentration involves greater volatility than broad diversification, and past performance doesn't guarantee anything about the future. All investing involves risk. But for investors who are generally asking whether their current plan is built to protect what they've spent a lifetime to accumulate, this approach is worth understanding. And that brings me to why I'm recording this. Because I want to make you an offer, and it's not the offer you're expecting. You've probably seen the ads: free consultation, no obligation review. Every financial advisor in the country is offering some version of that. And look, a second opinion on your portfolio is extremely valuable. I believe that. And if you're in the 25% who aren't happy with your current advisor, you should absolutely get one. But that's not what I'm offering today. Here's what I want to do. I want to offer you a real purchasing power session. One conversation, no sales pressure, no pitch deck, no generic allocation review, a focused, specific session built around one question. One question, and only one question. Given where energy prices are headed, given the inflationary pressures that are building in the economy right now, is your current plan actually protecting your purchasing power? And if not, what would? Here's what the session includes. First, we look at real inflation sensitivity of your current holdings, not the official CPI, the actual goods and services you buy: healthcare, food, fuel. We look at how your plan performs against that reality, not the headline number. Secondly, I'll walk you through the 1966 to 1982 envelope, not in the abstract, but with your actual allocation, so you can see, based on what you own right now, what that period would have meant for your purchasing power. And yes, history does not repeat, but that it rhymes, and there is a lesson there. Third, I'll share the specific business characteristics we look for in focus stocks. What makes a company genuinely inflation resistant? You'll walk away with a framework for evaluating any stock or fund, something you can use whether you ever choose to work with me or not. And fourth, I'll give you 3 questions to ask your current advisor. Questions that'll tell you very quickly whether they really have an answer, a real answer, for the environment we may be entering. You leave that conversation with real insights, a real framework, real questions that you can take anywhere. Whether you choose to do business with Adams Financial Concepts, that's entirely your call. There's no pressure. There's no follow-up sales sequence. The session is value just on its own. And here's why I'm willing to do that. Because I think once investors understand what a genuinely different approach looks like, one built for real purchasing power, not just nominal returns, the conversation becomes obvious. And before I close, let me leave you with one final thought. I opened this session with a question. 1 in 4 investors with a financial plan is unhappy with their advisor, and most can't quite name why. I think I can name it now. It's not that the plan is bad. It's that the plan was built for a world that may be ending, a world of stable, moderate inflation, predictable rates, a Fed with room to run, a world serving investors well for 40 years. But the Strait of Hormuz is disrupted. Energy markets are repricing, and the quiet grinding force of stagflation, the thing that ate purchasing power from 1966 to 1992, is probably returning. Investors who navigate what's coming won't be the ones who held on and hoped that their advisors had a plan. They'll be the ones who asked the hard questions early, who understood their real exposure, who looked at the history that starts before 1982. You've just spent 20 minutes doing that work. That puts you ahead of most people. Don't stop now. Book the session. Come talk to me. Walk away with something real. The link is below. I'm Mike Adams with Adams Financial Concept, independent thinking for independent advisors. That's what I offer. And now it's up to you. Let me ask if there's any questions.
Hey, Mike, it's Chris Prouty, and hello, everybody that's here. It's Chris Prouty. I am back to moderate the chat and answer the questions. Before I get to the questions, I will direct your attention to the webinar chat, which you can get to by clicking on the chat icon at the bottom of your screen. And there you will find in the chat, I have just pasted in a link where you can schedule directly on Mike's calendar. So if you would like to take him up on his generous offer today, you can click on that link and pick a time that is convenient for you, and then you and Mike will meet one-on-one. So once again, you can find that in the webinar chat. And then I'm also placing another link into the webinar chat, which is the link to our YouTube channel. And you will be able to see a replay of this broadcast as well as all of our previous broadcasts on that channel. And you can go back and watch these and continue to absorb the lessons that Mike has taught. And you can simply click on that link, head over to YouTube, and that will bring you right to the channel. If you find value in the videos that you watch, we ask that you kindly subscribe. That helps us surface in front of more people who will get benefit from this information. Mike, somebody asks, let me see if I can get back to the questions. Somebody asks how, they just simply asked, how long do you think the Straits of Hormuz situation is going to last?
My real guess is that it's going to be a short time. I believe there's tremendous pressure building on this administration to get it resolved. I think it's going to be resolved by giving in to most of Iran's demands, rebuilding Iran, allowing Iran to actually charge a toll for the ships going through, and spending trillions of dollars to rebuild what we bombed. Uh, uh, and I think it boils down to one thing. If they say we'll give up our uranium, a deal will get done. And I think there's going to be, I mean, they had 10 points. My guess is that this administration is concerned enough with elections coming up, with what's happening coming, that they'll give in. And if they can get just the one, that they can say Iran will never have a nuclear bomb, they'll concede everything else. That's my guess. Could be completely wrong. It's a pretty pessimistic outlook. But if that doesn't happen, it's going to be a long-term thing. And I think the idea is to plan for either one or the other. That's what's the point of today.
Thank you, Mike. Next question. If stagflation lasted 16 years in the past, is there a potential it could last that long now?
Absolutely. Although I think we learned from the 1960s and 70s how to deal with it. It's not a very easy thing to deal with. The way we dealt with it is by raising interest rates and raising interest rates and raising interest rates until the economy truly slowed down. I can remember talking to a business person at that time. Business was so bad. And when I asked him how business was, he said, even the people who don't pay their bills are not buying. And if you're a business person, you really recognize what that means.
Like somebody follows on to that question and they say, did any investments actually do well during the 60s, 70s?
Oh, yeah. Those are the ones that we would be looking for and doing. If you look, they were companies that benefited from changes in lifestyles, demographics, and technology. Let me just name three. Number one was a little company that had restaurants that changed how we eat out. There was no place to sit down. All restaurants before that had a place to sit down, or at least almost all restaurants had a place to sit down. This was a restaurant where you drove up, ordered your hamburger and fries and milkshake, and drove away. Of course, it was McDonald's. It came public in 1966, and $10,000 invested in McDonald's grew tenfold during that period of time. The second one was a radio repair shop
Mm-hmm.
doing radios. Back in the time when radios had tubes, TVs had tubes, they were repairing radios and TV sets because it was worth doing a repair rather than replace. And they realized that was what was happening in technology were these little things called transistors replacing tubes. And they became a distributor of those components, of transistors and electronic components. That was a company that was a radio shop. Investing in their stock would have grown 20-fold. And another company, again, technology, was a company that came out with and designed random access memory chips,
Mm-hmm.
advanced micro devices. And the company in 1972, stock price was $10. By early 1980s, 1,700. Those companies did well. They did well. They had volatility during that period of time, but there were companies that did well. And as I mentioned in the presentation, it's finding companies who have pricing power, who have a competitive advantage, and who really benefit from changes in demographics, lifestyles, and technology.
Mm-hmm.
Long answer to a short question. Hope that helps.
That was a very comprehensive answer, and I loved it. Next question, and I'm going to jump in and provide a little bit of an answer on this one as well. And that question is, I'm already retired. Is it too late for me? And Mike, before you answer, I will direct you, who's asking that question, and everybody who's here to the YouTube channel, to check out some of our case study videos, including one that was published about Sandra, who was told she was going to run out of money by age 72, and when she ultimately passed, had almost $750,000 still in her account. And that's one of the many case studies that we have in the YouTube channel. These are short vignette videos that tell interesting stories of people who Mike has helped along the way, and they're very inspirational. But Mike, to that question, somebody's already retired and they're asking, is it too late?
Of course, you know, if you're retired, you're more vulnerable than most people. People that are working, if they can keep their jobs and keep pushing money into their account and keep pushing money, keep growing their own wages or salaries, they have an advantage over retirees. Retirees with a fixed income, as purchasing power goes down, the damage is really great. I mean, I talk about a widow whose husband died in 1978, whose purchasing power dropped by 40%, whose bonds purchased at that time were called away and couldn't be replaced. So her income, actual physical income, went down in a very, very difficult financial situation. You know, bailed her out, and she lived for another, if you think about it, 1986 to 2010
Mm-hmm.
is 24 years, and didn't have to change her quality of life. That's important.
And Mike, with that, there are no questions remaining. I will remind everyone that in the webinar chat, I have a link that you can click on to schedule a direct one-on-one meeting with Mike. And it is a 30-minute session as he described in today's episode. I will also, for the people who are watching this on replay, I'll make sure that that link is included in the video description so that you can take advantage of it as well. Mike, the question that I have queued up as I do every week, what is on tap for next week?
AI, who will benefit? Who
Mm.
will benefit? I think it's a question a lot of people have to ask. Will workers benefit? Will consumers benefit? Will investors benefit?
Hmm.
Big question coming for next week.
I'm looking forward to that one. Mike, still no questions left in the chat. So with that, I'll hand it off to you for the final word.
Thanks for being here. Please, if you miss any part of this or any of the others, go to YouTube and check them out. And if you go to YouTube, do subscribe. I know this is a difficult time for a lot of people to get and manage. The YouTube videos and podcasts are there 24 hours a day, 7 days a week. So do that. And otherwise, have a wonderful week. And I will see you next Thursday.